Hi there, it's John Thompson with TG Loans Mortgage Team with today's Borrow Smart, Repay Smart lesson. Today we're talking about FICO scores and the impact that they have on all areas of the mortgages and so forth. So let me go ahead and jump into it over here. Bear with me a moment. Get rid of that. All right, so let's go here. So FICO score impact really is huge. We've seen a significant change in this. It used to be that years ago in the mortgage business that you got rewarded for having a good credit score. So in other words, you as your credit score went up, lenders gave you incentives because they give you better pricing and so forth. Now it's completely flip-flopped since the financial crisis in 2008. And what's happened now is that lenders expect you to have perfect credit, and as you don't have perfect credit, you get dinged for that. So as you go down in credit scores, it starts to affect you pretty significantly, right? And so it affects your interest rates, it affects the cost of getting a mortgage, it affects your down payment qualifying. Sometimes there are minimum credit scores for down payments, especially the larger the loan gets, you have to have minimum credit scores. Certain products require minimum credit scores, and then qualifying. The higher the worse the credit score, the higher the interest rate, and therefore it can affect your ability to actually qualify for the mortgage you want. One really key piece of information to know is that the mortgage scores that are offered on many banking services and through your phone apps and Credit Karma and so forth, all those things are not the same as credit scores that are offered by mortgage lenders. There's very different models. Each one is a proprietary model. They're not all the same, so you got to be really careful. And often the consumer ones, credit scores are significantly higher than the ones you see on a mortgage, because of course there's greater risk with a mortgage. So we're going to talk about both a quick purchase and a refinance and kind of see how it affects it. So in this example, we're looking at an $850,000 purchase. We're looking at a 20% down payment. We're looking at three different credit scores, 745, which should be good. Really, once you get above 745, the scores are pretty much the same. There's a few instances where that's not true in sort of the super jumbo marketplace. But for most things, 745 would be considered above 740 the best score you can get, 695 and then 675. So here's an 850 purchase, $680,000 mortgage based on today's rates, approximately with no points. You would be getting around 3.875, which would give you a payment of $42.60. And over a 20-year period, here, you pay $405,000 in interest. Okay, and that interest would represent about 39% of your overall payments. So that's not bad. That's pretty good. Coming over to here, you to the 695 credit score. Now you've got a 4.5% rate, so you'll jump up quite a bit. Your payment is $45.07, so you went up quite a bit there as well. Your interest cost over 20 years is $479, and now is 44% of your credit score. That same mortgage costs you $74,000 over that 20-year period. Now going one more step, 675, 5.375, 4870, 586 in credit scores, and it's costing you $181,000 more than if you had that better credit score. And believe me, it's not that difficult to get from 675 to 745. It just takes some diligence and a little bit of time. So now let's look at the impact on a refinance. So let's say someone had $1 million home, they have an existing mortgage of 575 and a rate that's still in the upper fours. That'd be a mortgage taken out a couple of years ago. That would have been a great rate at the time, but now the market's a little bit better. But they want to pull cash out. Pulling cash out in and of itself costs more than just refinancing the mortgage. If this mortgage was just being refinanced with no cash out, the rates would be very similar to what you saw on this page over here. But with cash out, it's going to cost a little more. So nonetheless, the objective might be to pull cash out, lower interest rate, and maybe get our payments a little bit better. So here we go, 745 FICO score, 4.375. Your payment's $33.70. So actually saving $70 a month on the payment. And you got your $100,000. So that's a good thing. That would have worked out fine. That would have been a great plan. That $100,000 could be invested. It could go back into the house and be paying for college and so forth. But 695 credit score, now the rate is actually higher than where they were already. So now the payment's going up by $184. They do get the $100,000, and maybe that's worthwhile depending on what's going on with it. But it might be better to try and improve the credit score. And then as we go to a 675 credit score, now the rate's all the way up to 5.5. Now the payment's going up by $393 a month. 38.33, and it's costing quite a bit of money over time. All right, so bottom line is you kind of work on your credit score. It's more critical than ever to focus on a good credit score. The most important element of this is being less than 35% usage, meaning that of your credit cards, if you've got a $10,000 credit card, you want your balance to always be under $3,500. And of course, zero is better. But if you have to have a balance, you want to be under about 35%, and even better be 30%. In fact, you'll see here a utilization rate of 30%. All right, so don't close your old accounts. It does take time. Lenders don't let you work on credit scores during transactions. You need to wait 90 days between credit reports. Really important. And if you ever want to go look at this yourself, this is a free site, annualcreditreport.com. You don't need to pay for it. You can get a free credit report from each one of the bureaus one time a year. There's 3 different bureaus, so that's a great way of doing it, and you should be checking that at least once a year on each bureau. Okay, so that's it. Hope you enjoyed this lesson. One quick other element I want to remind you. Oops, sorry. If you want to learn a little more about what we do and what's important to us, check out our book, Borrow Smart, Repay Smart, and give us a call, email us, and I'll be happy to send you one. Take care.